All right, so we know that with a standard accumulation model, the general consensus is that you need to have the swing low pulled for a move up to the high, right? You need to have your range low pulling it up towards that swing high. So AKA price is pulling in a downwards direction. That's your typical accumulation model. With the reaccumulation model, it can happen in an uptrending environment, even if you pull from high to low, where it almost looks like it should be a distribution, but then it ends up going higher, right? You could even have the telltale signs of a distribution like this, and then all of a sudden it breaks down lower, comes up one more time, and it looks like it's just hitting that last supply range for the third tap, or this could have been the third tap, and then it just kind of goes like this on you, and you're like, whoa, what just happened? So a lot of the time when that happens, there's a reason. There's always a reason. So perhaps, again, you have a very strong upwards trend, right? On a higher time frame swing structure, it just makes sense to go higher. Maybe this was a demand zone that just couldn't get mitigated previously, and it just so happened to get hit now. So it made sense to hit this demand zone ultimately. And yes, it is still a valid distribution schematic where you have the tap 1, the tap 2, either tap 3 or tap 3 here after breaking structure bearishly. So you had a valid model 2 distribution, but it just so happens that the distribution didn't really have any legs to it. The final product of that distribution was actually a reaccumulation where you have the tap 1, the tap 2, the tap 3 of the accumulation. So the rules are the same. Okay, they are the same, but these are a little bit trickier to play because you really, really have to look at your return to zone considerations when you're playing these, okay? I strongly suggest you try to avoid them, okay? So generally, if you're pulling from high to low, meaning that price action's in an uptrend just like this, you should be focusing on shorts. You shouldn't be focusing on trying to long these moves down here. Unless you're really sure that it's going to go higher and that this is not going to be a valid distribution, because most of the time, it's going to be a distribution over a reaccumulation, okay? Most of the time, that's how it's going to play. Now, the better way to reaccumulate, obviously, is when you have like a short squeeze. Like, let's say price is coming down, you have a move down, you have a move up, you have a move down, you have a move up. And there's nothing but inefficient price action here. It's been trending down for quite a while. It's been trending down for ages. And then all of a sudden, you get that classic accumulation kind of thing. And then it goes pop. Slight bull flag, as the retail folks call it. And there's a reaccumulation here. Perhaps it nipped the low right here and then nipped the low right here as well, right? Where you reaccumulate it to go higher, right? That's an example where you ended up pulling the range high to that range low. You had the tap 1 and the low, tap 2 and tap 3, where it didn't take any of the highs at all. Okay, cool. Yeah, you can play it just like any other accumulation model, but it is technically called a reaccumulation and not a distribution or standard accumulation. Okay, it's actually a reaccumulation because it's happening in an uptrending environment. So that's something to know, right? But again, they are trickier to play. They're always going to be trickier to play. You're not going to see them as often, right? You're definitely not going to run into these as often. But remember, if you're going to try to play these as well, watch your return to zone. Okay, you have to make sure there's a reason to come back up again. And because you're fighting a plain as day distribution, or you're fighting a plain as day accumulation schematic. So trying to short right here or trying to short right here, it's kind of sketchy, right? Knowing that you had the 1, the 2, and then the 3. Key thing, little trick here that we can watch. Always watch the volume, because when it ends up breaking that range high, if you're seeing a huge decrease in volume, that's usually a sign that it could be a redistribution or a reaccumulation, okay? Meaning that it ends up being a failed accumulation or failed distribution model. So the objective of the 1, the 2, the 3 was actually, let's say, to go down to here or here, but then volume didn't have any follow through. Volume was just dying. As it ended up breaking the range low here, volume died substantially. That means that this distribution has no legs. There's no more interest to sell this asset. So what could happen? Well, just another mitigation, and then a lower low, and then up, right? Does it have to make a model 1 for reaccumulations and redistributions? No. It can make a model 2, just like any other model 2. The same rules apply. You're playing the structure. Okay, you're always playing structure with these things. Any Wyckoff model, it's the structure. It's not the Wyckoff. Remember that. We cannot stress that enough. I have another drawing here that I want to show you guys. So we have a redistribution and a reaccumulation. Okay, now as you can see, yes, this was a standard distribution schematic. Tap 1, tap 2, tap 3. They even broke the range low with the close. Okay, great. Made that lower high into this pretend order block right here, and then it went down lower. But then volume started to decrease. right? And then so a range was basically born in the process, because what happens when volume decreases? Ranges create themselves, right? You could also argue this was a significant expansion away, and now the price needs to do something before it can go lower again. So how would a redistribution apply? Well, they do tend to follow distributions pretty often, especially if the distribution has some legs to it, right? A really nice expansion leg down. So in this case here, notice how I pulled the low to the high. Well, yeah, because it's in a downtrending environment. I have to. So swing low, swing high, confirmation of my range. Okay, but look at the return to zone on this. Look how it never swept out the low. Key indication, you're always watching to see if it could be an accumulation. And what do we need to happen for this to be an accumulation? We don't want to short into an accumulation, right? You definitely don't want to short into an accumulation. So what can we watch? Well, do we take this low? Because if we don't take this low, there's an even greater chance that it's going to be a redistribution. In this case, the way that I have indicated on my drawing here, we did not take out this low. That's a good sign. So what kind of process needs to happen? Well, you're looking for the same 3-tap lingo, right? You want to see 3 taps like a Model 1, or you want to see 3 taps like a Model 2. Same idea, either supply or 3 taps higher for Model 1. So in this case here, as you can see, the return to zone is very, very nice. You got that classic curving up effect the entire time. So all these lows were remaining intact the entire time. All these lows here have dollar signs under them. Price ultimately purged up here one more time, then it decided to break structure. There you go. You have yourself a redistribution effect. So if we scroll down a little bit further, we can look at an actual example here. All right, let's go to the 4-hour first. So on the 4-hour time frame, you had yourself a distribution model 1, where you had the swing high formed, price came down and formed its swing low. It came up right here and formed its midpoint. So that's a valid range. So we had a tap 1. Price then deviated tap 1 with a tap 2. It broke some sort of internal structure here, sure. But ultimately, it didn't break the range low, so it wasn't ready to go lower. It decided to come up one more time. When price came up one more time, it formed the entire tap 3. It's kind of a weird tap 3, but it's still a tap 3. I say weird because really, that's a range on its own, right? This could have been another model on its own on a lower time frame. Kind of looks like it has that rounded effect. And it wasn't just a quick wick in and a quick wick back under the range high, right? It actually took its time up there. So it's not too common to see that, but it still happened in this example. Okay, so what happened following the 3rd tap of this? Well, let's see. Let's go down to the 15. This is 3. On the 15-minute time frame, as you can see, when price made its way back within the contents of that range, go back to the range template, there we go. This was the previous range. It came back within the range. Look what happens here. It makes its lower low, lower high, a lower low, a lower high, and a lower low. But look what happened during this lower low to lower high here. Observe. You had a swing low form in a downtrending environment. You would have pulled your range high up like this. Notice something. Look at this beautiful return to zone here. The curling up effect, right? This is exactly what you want if you're trying to play a distribution during a downtrending environment, also known as a redistribution, okay? So you may have been waiting for this to be swept out, but because it wasn't swept out, you had that vibe because it kept deviating the high, that it was going to be a redistribution, okay? So in this case here, swing low formed. That's tap 1 on the low. That's tap 1 on the high. The swing high was swept or ran. There's tap 2 on the high. Then, as you can see, we had that final spike above, this whole thing being tap 3 with follow through. Very nice follow through. Purging all this curvature liquidity in the process. Very beautiful return to zone. Successful target by going lower. Ultimately fulfilling the job of the bigger distribution by going very, very aggressively down, right? Came down, smacking down. And that's a beautiful example of a redistribution. So in all honesty, I'm not going to spend hours upon hours upon hours trying to slam redistributions or reaccumulations in everybody's head. The way that I suggest you trade them is more from a power of 3 standpoint. Please refer to the power of 3 video, okay, if you want to learn about that. Meaning that you're going to watch for these very nice return to zones, as I mentioned, right? The return to zone is crucial. Let's not overachieve, right? We just want to be able to use this from a bias standpoint. We're going to trade the structure. We're not going to worry too much about the redistribution or reaccumulation effect, but I can tell you for sure, if you notice that you're in a trend and you form this and you form this, your high and low of a range in an uptrending environment, and you see clearly that it's not taking that high, and it keeps coming down and deviating low, and then coming up a little bit and deviating to low again, doesn't that look pretty bullish to you? Because it looks like it's pretty bullish to me. I'm not really seeing much of a reason to just melt down here if it keeps reclaiming. If anything, if you get that structure change, you should be looking for longs here to drive it up further, and it's probably a reaccumulation. Upside down, let's see. In a downtrending environment, if you have your low form and then your high form, and then the range confirms itself on the midpoint, and you have that, for some reason, my dollar signs just got all wonky. But if you have that curling up effect again, but you're not taking the low, then why is it going to be an accumulation? It's probably not, right? It's probably not an accumulation. You're probably looking at a redistribution, especially if you have the telltale sign of your second tap. You will find that these redistribution and reaccumulation models tend to be model ones more than twos, okay? They generally are ones more than twos, statistically speaking, but that doesn't mean you can't have a two. With your standard accumulation and standard distribution, it's the other way around. You actually get 60% model twos and 40% model ones approximately, statistically speaking in crypto, okay? I can't tell you the stats in traditional markets, but I can tell you the stats in crypto markets. So it's more common to receive a two in a general accumulation or distribution model, whereas the other way around for a redistribution and reaccumulation model. Okay. But remember, we always prepare for both situations, and we're always trading the structure anyways, because we're smart like that. So it doesn't really matter what happens as long as we're paying attention to structure, and the Wyckoff is the cherry on top to give us a better bias, really.